Welcome to Market Meridian's live earnings preview, where we break down the most critical trade setup of the day, Netflix NFLX Q1 earnings, set to drop after the closing bell. I'm your host, and today we're focusing on whether the streaming giant's post-Warner Bros. Discovery, WBD, rally can hold, and what traders need to watch to profit from tonight's move. This isn't just another earnings report. It's the first real test of Netflix's standalone strategy after walking away from the WBD merger, a decision that sent its stock soaring 25% plus in just over 2 months. For active traders, institutional investors, and even casual market watchers, tonight's numbers and commentary will answer the most pressing question: is Netflix's recent rally justified, or is it a hype-driven bounce that's due to reverse? We're going to break this down step by step, from the current market setup to consensus expectations, sell-side commentary, key catalysts to watch, actionable trade strategies, and the wildcards that could derail even the most well-thought-out positions. Let's dive in first. Let's set the stage. As of today's session, Netflix shares are trading at $108.26, up 0.5% on the day, and riding a stunning 25% plus rally since management walked away from the WBD merger in late February. That rally isn't just noise, it's the entire backdrop for tonight's print, and it's built on one key. Street rewarded it for avoiding the pitfalls that come with large-scale acquisitions, massive debt buildup, years of regulatory scrutiny, and the operational nightmare of integrating two huge media companies with conflicting cultures and strategies. But here's the catch: that rally was based on a narrative, not on concrete results. Tonight, the rubber meets the road. Investors and traders alike will be looking for evidence that Netflix can thrive as a standalone company in an increasingly concentrated streaming landscape, one where Disney, Paramount, and a potential Paramount-Skydance combination are all vying for the same subscribers, ad dollars, and content talent. 2 months ago, this earnings report was supposed to be a victory lap for the WBD merger, a chance for management to celebrate a transformative deal that would have reshaped the streaming industry. Instead, it's a make-or-break moment for Netflix's new identity, a disciplined, focused player that doesn't chase growth at all costs, but instead prioritizes profitability, user engagement, and strategic investments. To understand what's at stake, we need to first look at the consensus expectations, then dig into what the sell side is saying, and finally map out the trade signals that will dictate tonight's move. Let's start with the consensus numbers, via Refinitiv. Analysts are calling for earnings per share, EPS, of 76 cents and total revenue of $12.18 billion for the first quarter. Now, at Market Meridian, emphasized that consensus numbers are just a baseline, they're not the end-all be-all of earnings season. In fact, our analysis suggests that these numbers won't be the primary market mover tonight. Why? Because the market has already priced in a good enough quarter. The 25% rally since late February isn't just about avoiding the WBD merger. It's about the market's growing confidence that Netflix's core business is strong enough to stand on its own. What will move the needle tonight is not whether Netflix beats EPS by a penny or two, but what management says about the future, specifically, their 2026 full-year guidance, the trajectory of their ad-supported tier, how they plan to use that $2.8 billion breakup fee, and their commentary on user engagement. These are the variables that will either validate the recent rally or trigger a sharp pullback. Let's break down each of these in detail, starting with the most critical, the post-Warner strategic shift point. 2 months ago, the narrative around Netflix was all about integration. How would they merge Netflix's streaming technology with WBD's vast content library? How would they navigate regulatory hurdles in the US and Europe? How would they manage the debt that would come with the acquisition? But when Paramount and Skydance outbid Netflix for WBD, all of those questions became irrelevant. Suddenly, Netflix was no longer a company preparing for a merger, it was a company that had just and a clean slate to focus on its core business. Forrester's Mike Prue put it bluntly in a recent note: heading into this earnings print, Netflix is in a very different spot than anyone expected 6 weeks ago. The question is no longer about integration risk, it's about how Netflix competes in a streaming top tier that's about to get a lot more concentrated. That's a key point. The streaming industry is consolidating, and Netflix is now facing a more competitive landscape than ever before. Disney Plus has millions of subscribers, Paramount Plus is gaining traction with its sports and entertainment content, and the potential Paramount-Skydance merger could create a new powerhouse with deep pockets for content and marketing. Netflix's job tonight is to convince the market that it can not only compete in this environment but thrive, without the crutch of a merger. To do that, management needs to deliver clear, confident commentary on their strategy, and back it up with solid numbers. Let's turn to the sell-side commentary, which is critical for traders looking to position themselves ahead of the earnings release. At Market Meridian, we've reviewed dozens of analyst notes from the top Wall Street firms, and there's a clear divide between the bulls and the cautious few, but the bulls are currently in control. Let's start with the most bullish voices, then move to the skeptics, so you can get a balanced view of the market's expectations. Morgan Stanley's Sean Diffley just initiated. Coverage of Netflix with an overweight rating and a $115 price target, and his framing is the cleanest bull case we've seen. In his note, Diffley calls post-WBD Netflix a cleaner, higher visibility, and lower volatility business that is no longer weighed down by the uncertainty of a massive merger. He also highlights a critical trade signal that traders should pay close attention to. Since 2015, owning Netflix after a U.S. price hike has averaged a 20% return over the following 9 months. Netflix raised its U.S. prices in March, which means if history repeats itself, there could be significant upside ahead, assuming tonight's earnings don't derail that trend. Diffley also believes that AI, which has been a source of concern for investors due to fears of high spending and unproven ROI, will soon flip from a risk narrative to an opportunity narrative. As Netflix uses AI to improve content recommendations, reduce churn, and optimize its ad targeting, Diffley expects the company's valuation to re-rate back above 30x, which would be a significant boost from its current levels. Next up is BofA's Jessica Reif Ehrlich, who has a buy rating and a $125 price target, one of the highest on Wall Street. Ehrlich's take is more nuanced than Diffley's, but equally bullish. She focuses on Netflix's March price hike, which came earlier than the street expected. In her note, she writes that the timing of the price hike reads as a validator of management's confidence in underlying strength and durability of the business. For context, Netflix has been facing questions about user engagement over the past 12 to 18 months, with some analysts warning that subscriber growth could slow as the market becomes saturated. By raising prices earlier than expected, Netflix is sending a signal that it believes its content lineup and user experience are strong enough to justify higher costs, without triggering a wave of cancellations. Ehrlich also notes that the ad-supported tier is gaining traction, which should help offset any subscriber losses from the price hike and drive long-term profitability. Wedbush's Alicia Reese is another bull, with an outperform rating and a $118 price target, and she's pounding the table on Netflix's ad tier, arguing that it's the company's biggest growth driver in the coming years. Reese expects ad revenue to at least double to $3 billion this year, up from an estimated $1.5 billion in 2025. She also believes that the $2.8 billion breakup fee gives Netflix room to keep extending its competitive lead by investing in ad technology, content, and marketing. What's notable about Reese's analysis is that her Q1 estimates are slightly above consensus. She's calling for revenue of $12.22 billion and EPS of 77 cents, which is marginally higher than the refinitiv consensus of $12.18 billion and 76 cents. If Netflix hits Reese's numbers, it could be a positive signal that the ad tier is growing faster than expected, which would likely boost the stock. Evercore. Mark Mahaney, who has an outperform rating and a $115 price target, offers a more balanced take. He calls the street's current estimates highly reasonable, but he warns of a key risk: the stock would likely trade off modestly if Netflix doesn't raise full-year guidance. That's a critical benchmark for traders to keep in mind tonight. Netflix currently guides to $51 billion in full-year 2026 revenue, which represents 14% year-over-year growth. If management maintains the guidance, it's likely neutral for the stock, but if they cut it, or even fail to raise it, the market could interpret that as a sign of weakness, triggering a pullback. Mahaney also notes that Netflix has a strong track record of beating revenue estimates 9 out of the last 10 quarters, which is why bulls are comfortable holding the stock into earnings. But he warns that a small beat probably won't be enough to push the stock higher, given the 25% rally that's already priced in. In other words, Netflix needs to deliver a beat and raise to justify the recent gains. And now, let's turn to the one skeptic worth reading, Benchmark's Daniel Kurnos, who has a hold rating on Netflix. Kurnos is impressed with Netflix's pricing strategy. He acknowledges that the March price hike makes sense from a profitability standpoint, but he raises a fair caveat: the last time Netflix raised into a tough macro was 2022, and subs missed expectations that time around. For context, in 2022, net inflation and a weakening economy, and it ended up losing subscribers for the first time in years. Kurnos notes that the situation is different now. Netflix has an ad-supported tier that can absorb some of the pressure from price hikes, but he warns that the bear case hasn't disappeared, it's just been drowned out by the recent rally. His note is a reminder that traders shouldn't get complacent. Even if the narrative is bullish, there are still risks, and a single misstep from management tonight could trigger a sharp sell-off. Now, let's get to the actionable part, the part that matters most for traders: Market Meridian's trade strategy. We're going to break this down into clear buy signals, sell signals, entry and exit points, stop-loss levels, and risk management tips. Our strategy is built on the idea that tonight's earnings are a binary event: either the narrative of a disciplined, standalone Netflix is validated, or it's not. There's little middle ground, which means volatility will be high, but that also means there's significant profit potential for traders who position themselves correctly. First, let's outline the buy signals. We're looking for 2 core triggers, plus 1 or 2 auxiliary triggers, to confirm a long position. The strongest buy signal is if Netflix raises or maintains its 2026 full-year guidance. As we noted earlier, the company currently guides to $51 billion in revenue, 14% growth. If management raises that guidance, say, to $52 billion or higher, it's a clear sign that they're confident in the business's growth trajectory, and it will likely validate the recent rally. If they maintain the guidance, it's neutral to slightly positive, but we'll need another trigger to confirm a buy. The second core buy trigger is positive commentary on the ad revenue trajectory. Management has already said they expect ad revenue to double from 2025's $1.5 billion to $3 billion in 2026. Tonight, traders need to hear confirmation that the run rate is on track. For example, if management says Q1 ad revenue was $750 million or higher, that would indicate the double target is achievable. If they provide specific numbers or metrics, like ad impressions, average revenue per user, or subscriber growth for the ad tier, that's even better. Now, the auxiliary buy triggers. These are not deal breakers, but they can strengthen the case for a long position. The first auxiliary trigger is beating consensus by a meaningful margin. We're not talking about a penny beat on EPS or a few $1 million on revenue. We're looking for a clear beat: revenue above $12.3 billion and EPS above 79 cents. That would show that the core business is stronger than expected, and it would reinforce the bullish narrative. The second auxiliary trigger is announcing a large stock buyback. With $2.8 billion in breakup cash, Netflix has the ability to repurchase shares, which would be a sign of management's confidence in the stock's undervaluation. Announcement of at least $15 billion over the next 12 to 18 months, anything less than that might be seen as a lack of conviction. The third auxiliary trigger is positive commentary on user engagement. Gabelli's John Belton calls engagement the lifeblood of Netflix, and for good reason. If users are watching more content, they're less likely to cancel their subscriptions, which means higher retention rates and more revenue from both subscriptions and ads. If management says engagement metrics, like average watch time per user, completion rates, or content interaction, improved quarter over quarter, that's a strong signal that the content lineup is resonating with subscribers. Now, let's talk about entry points for a long position. There are two approaches, a direct entry after earnings, and a more conservative pullback entry. For aggressive traders, if the stock trades at $112 or below after the earnings release, and the buy signals are triggered, that's a solid entry point. We recommend setting a stop loss at $104, which is a 7% downside buffer. This limits your losses if the trade goes against you. Our target price for this entry is $120 to $125, which represents a 10% to 15% upside from current levels. For more conservative traders, we recommend waiting for a pullback to $100 to $103. This pullback would likely happen if the earnings are good but not great. For example, if Netflix maintains that there should be no guidance cuts, no ad revenue misses, no negative commentary on engagement. For this pullback entry, set a stop loss at $97, a 4% downside buffer, with a target price of $112 to $115, a 9% to 12% upside. This approach reduces your risk by waiting for the market to digest the earnings news before entering. Now, let's outline the sell signals. These are non-negotiable. If any of these triggers hit, you should consider selling immediately, either to lock in losses or protect gains. The biggest red flag is if Netflix cuts or fails to maintain its 2026 full-year guidance. As Evercore's Mark Mahaney warned, this would likely trigger a sell the news setup, as it would signal that management is less confident in the business's growth. Even if Netflix beats Q1 consensus, a guidance cut would overshadow that and lead to a pullback. The second core sell trigger is ad revenue falling short of the doubling target. If management says that ad revenue is not on track to reach $3 billion in 2026, for example, if Q1 ad revenue was below $700 million, or if they lower their ad revenue guidance, that's a major. The ad tier is supposed to be Netflix's growth engine, so any sign of weakness here would undermine the bullish narrative. The auxiliary sell triggers are also important to watch. The first is missing consensus by a meaningful margin. Revenue below 1 would likely trigger a sell-off. The second auxiliary trigger is declining user engagement. If management says that engagement metrics fell quarter over quarter, or if they express concern about subscriber retention, that's a red flag. The third auxiliary trigger is no clear plan for the $2.8 billion breakup fee. If management can't explain how they'll use the cash, whether it's for buybacks, content, ad tech, or debt reduction, the discipline narrative falls apart. Investors will interpret this as a lack of strategic vision, which would weigh on the stock for exit points on a short position, or to sell an existing long position. There are a few scenarios. If hits, sell on the opening gap or any rebound after earnings. Don't wait for the stock to fall further. Our target price for a sell-off is $95 to $100, which represents a 7% to 12% downside from current levels. For technical traders, there are two additional exit signals. First, if the stock breaks below its 50-day moving average, which is currently around $105, that's a bearish technical signal that the recent rally is over. Second, if the RSI 14 climbs above 70, overbought, at the target price, that's a sign that the stock is due for a pullback, and it's time to take profits. No matter which exit strategy you use, always stick to your stop loss. This is a high volatility event, and emotions can cloud judgment. Discipline is that could derail even the most well-thought-out trade strategy. First, options markets are pricing in a 6% to 7% move tonight, which means we could see significant volatility. Netflix has beaten revenue in 9 of the last 10 quarters, so bulls are comfortable, but a small beat won't be enough to push the stock higher. The market is expecting more, which means the bar is higher than usual. Second, keep an eye on Europe. A Rome court recently ruled that Netflix illegally pushed through price hikes from 2017 to 2024, and similar suits have been filed in Germany, the Netherlands, and Poland. This won't impact Q1 numbers, but if management says on the earnings call that these lawsuits could lead to fines, refunds, or limits on future price hikes, it could weigh on the stock. Europe is a key market for Netflix, accounting for roughly 30% of its revenue, so any regulatory headwinds there are significant. Third, macroeconomic conditions. If management expresses concern about a weakening economy, or if they say that subscriber growth is being impacted by high inflation or consumer spending cuts, that could trigger a sell-off, even if other metrics are strong. Another wildcard to watch is competitor activity. While Netflix is focused on its own strategy, the potential Paramount-Skydance merger could be a topic of discussion on the earnings call. If management is asked about how they plan to compete, confident, clear response would reassure investors, while a vague or defensive response could raise concerns. Additionally, if Disney or other streaming competitors announce any major moves ahead of Netflix's earnings, it could impact market sentiment, though we don't expect any major announcements tonight. To sum up, Market Meridian's take on tonight's Netflix earnings is clear. This is a test of the company's post-Warner reset. The recent 25% rally was built on a narrative of discipline and avoiding merger risks, but tonight, Netflix needs to back that narrative up with concrete results and guidance. The trade is binary. If management raises or maintains guidance, provides positive ad revenue commentary, and delivers solid numbers, the stock is likely to move higher, with targets of $120 to $125. If they cut guidance, miss on ad revenue, or fail to articulate a clear standalone strategy, the stock will likely pull back, with targets of $95 to $100. For traders, the key is to stay disciplined, stick to your entry and exit levels, use stop losses to manage risk, and don't get caught up in the pre-earnings hype. Remember, earnings season is about managing expectations, and tonight's Netflix report is no exception. Before we sign off, let's recap the key points to watch tonight, in order of importance. 1. 2026 full-year guidance, maintained or raised is bullish, cut is bearish. 2. Ad revenue trajectory, confirmation of the $3 billion. 20. Positive is bullish, negative is bearish. For the plans for the $2.8 billion breakup fee, clear strategy is bullish, no plan is bearish. 5. Europe regulatory updates, any negative news is a headwind. These 5 points will dictate tonight's move, so make sure you're paying close attention to the earnings release and the conference call. At Market Meridian, we'll be covering the earnings release live as it happens, with real-time analysis and trade adjustments. We'll be monitoring the key metrics, management commentary, and market reaction, so stay tuned for our post-earnings breakdown. Whether you're a long-term investor or a short-term trader, tonight's Netflix earnings are a critical event that could shape the stock's trajectory for the next few months. Don't miss it. That's our preview. Now, let's wait for the bell, and the numbers that will shape NFLX's next move.